Good morning, everyone. Thank you for joining us here this morning. Financial markets and our premier carrier, North American, and we'll begin here in 3 minutes. Good morning again, everyone. Thank you for joining Financial Markets and North American Company. We'll begin here in about 2 minutes. Good morning again, everyone. Thank you for joining Financial Markets and North American for this talk today. We'll begin in 1 minute.
Welcome to all. Welcome to fall. Welcome to all, and again, welcome to the fall, and the fourth quarter is just around the corner. I'm Ed Bartling, an external wholesaler for financial markets, and I want to say thank you today for participating, and thank you very, very much for your business and your trust in financial markets. Now, today we're going to share some very important information on protection for your existing clients and clients to be. First, a little housekeeping, if we may, please. All the lines have been muted, and please go ahead and use the tool there of the chat and any questions that you may have. Today's session is going to be recorded, and folks, at the end of the presentation, we're going to have a $50 gift card to give away. Now, you need to be present during the presentation and during the drawing that Neil Sperling will be holding there. Our Regional Vice President from North American, Andrew Herrera, and your internal wholesaler is ready to partner with you to help create and execute customized plans to grow your business by implementing effective marketing strategies, helping with training, and offering tailored solutions to meet your clients' needs. Now, Andrew joined North American from Principal Financial Group with over 14 years in the financial service industry. He spent the last several years working with general agencies like financial markets to design, implement, and deliver insurance-based solutions. Today, Andrew is excited to channel his experience and energy to help support your specific needs. He is ready to go to work for you. I present to you Andrew Herrera, Regional Vice President.
Thank you very much, Ed. And thanks, Neil, as well, and the entire team at the Financial Markets. Appreciate the opportunity to be with you this morning, or maybe afternoon, depending on where you're located throughout the country. And again, thank you, all of you that are in attendance with us. Appreciate you taking time. We know that your time is valuable, and I do want to be respectful of that. And so this morning, this afternoon, the topic that I want to talk about that Ed mentioned is really this: how to protect existing clients and attract new ones, especially as I think about the current environment we find ourselves in. This year certainly has been different than any other year that I've been in the industry, and I'm sure a lot of you can echo that sentiment. So again, I want to talk about for a few minutes just how can you protect existing clients today, maybe share an idea or two that'll work, and how to attract new ones. Once again, my name is Andrew Herrera, Regional Vice President with North American. So to get started and jump into this, I really think we need to talk about the client database, right? And the reason I think that's important is because I think that divides how you ask questions, right? How you approach maybe a potential client, right? Is to first analyze and say, what type of client is this? What's the right insurance-based solution that makes sense to them? So again, our agenda today, I'm going to talk about segmenting that client database and share just a few client solutions, some sales ideas, and then lastly, I'll wrap up with some tools and resources. So if we think about clients and segment them out, I think the first, maybe most obvious one is just by age, right? So the four groups we're looking at here is the traditionalists, baby boomers, Gen Xers, and millennials. And so I would challenge you, if you have existing clients, to think about them in these four categories, right? So say, how old is my client? Which one of these buckets do they fit into? What's the appropriate solution? Maybe what's the questions I should be asking them? If you're looking at potential clients, right, think about them in one of these four groups, age groups, and say, how do I approach this potential client? What's the best way I can approach them? What's the questions I should be asking? So we'll start out by looking at the traditionalist group. So this is ages 72 to 89. This group is currently, in retirement, increasing healthcare expenses. We know that people in this age group are likely, approaching, or maybe they're in a long-term care type event. So, the healthcare expenses are increasing for them. And then a lot of them could have RMDs coming due. Maybe they're already in the RMD taking years. We know that with the passing of the Secure Act, of course, RMD was pushed from 70 and a half to age 72. So, of course, if you're on the younger end of the spectrum here for traditionalists and you're age 72, maybe you're one of those that's going to be start taking RMDs here any day. Now, this group, if we think about in terms of the United States of America, this group makes up about 50 million people in the country today. 50 million people are traditionalists. Again, some of you may have clients that are in this category. Some of you may have potential clients that are in this category. And the primary opportunities when we think about this group are legacy planning, right? A lot of people in this age group are thinking about, how do I leave a legacy for my kids, for my grandkids, for a charity that's really important to us? How do we plan for that? Smart money, I'm going to talk a little bit about that concept in a few minutes. And then a lot of clients, again, in the traditionalist group, are trying to figure out, how do I maximize money that's coming out of an annuity? How do I maximize my RMDs, especially if they're clients that are not needing to use those funds and are saying, how can I leverage these dollars into something bigger? Again, that's a prime opportunity for the traditionalist group. The next group is the baby boomer group. So we're looking at those ages 71 to 53 on the younger side. Again, these baby boomers are at or near retirement. Obviously, if they're in the older age of the spectrum here, they're going to be in retirement. Those that are 53, 54, not quite in retirement age, but nearing retirement. This group has a lot of money in qualified funds. Again, if they're the younger baby boomers, they're still accumulating that in their 401ks or other type accounts. And if they're on the older age spectrum for baby boomer, they have a lot of money that they're probably drawing from already. Maybe they're drawing from, their 401k, their IRA, or whatever type account they have. And they're starting to think about long-term care expenses. And the reason they are is because they're probably seeing the financial impact that has had on their parents' generation, right? So the traditionalists. So these baby boomers, if they're not already experiencing a long-term care event themselves, they're thinking about that and they're saying, you know what? I know what it costs mom and dad to go into that facility. I know the impact that Alzheimer's has had on my, again, parent or sibling or whoever it is, family member, and they've seen the financial impact and they recognize that that's an important thing that they need to plan for financially. When we talk about population, I know we said traditionalists make up 50 million in the country. Baby boomers make up 75 million baby boomers in the United States today. The primary opportunities with this group are retirement planning. Certainly, again, for those that are in their 50s still, that are baby boomers, retirement planning is important for them, making sure they have enough. Social Security type planning, when they're thinking about, should I delay Social Security? What's a way that I can plan around that? That smart money concept I'm going to talk about here in a little bit. And then IRA planning. I think IRA planning is very important now, again, with the passing of the Secure Act and the elimination of that stretch IRA. There's a lot of opportunities around IRA planning that exist, especially with those clients that have a non-spousal beneficiary. So if they've named a child, a grandchild, maybe a trust as a beneficiary on that IRA, absolutely, that made sense a year ago prior to the passing of the Secure Act. But now that we know the impact that it's had and the fact that these non-spousal beneficiaries have to take money out within a 10-year window, the tax impact is going to be really great for a lot of these beneficiaries. And so there's a lot of IRA planning that we've seen done this year because of that. Moving on to the next group, right? Gen Xers, those ages 52 to 37. They're certainly not, in retirement yet. The older age group are rapidly approaching retirement age. A lot of them, especially the younger ones, are still paying down debt, right? So maybe there's still some college loans, mortgages, whatnot. And then again, if certainly the younger Gen Xers still have kids at home. Maybe some of the older Gen Xers are becoming empty nesters here, but primarily Gen Xers still have kids at home. So there's a lot of financial planning that needs to revolve around that. So we look at the primary opportunities. Certainly retirement planning is big for this group because we know that none of them are in retirement yet. College funding, again, especially for those that still have kids at home. And income protection, especially if they have a lot of debt that they're still paying off. Income protection is huge because there's still a lot of working years ahead. Gen Xers, I know we said that traditionalists were 50 million. Baby boomers made up 75 million. Gen Xers make up 55 million people in the country. And last, and I think they would certainly argue that they're not the least. In fact, this is the largest group here, 80 million millennials. 80 million millennials, the largest group, those ages 36 to 21. Especially if they're coming out of college, right? There's a lot of student loan debt in this country. And I'm sure many of you probably know people in your own circles, who have student loans or still paying student loans. They're having what we call life events too. A lot of millennials are having what we call life events because of their age. And what I mean by life event is they're having events like buying their first house, having their first kid, getting married, a lot of firsts in their life. And so those events are prime opportunities to have life insurance conversations. I would say now more than ever for two reasons. One, because I think COVID has brought mortality top of mind for so many people in this country. In fact, I know that right now we find ourselves in Life Insurance Awareness Month here in September, but I've heard so many people call this Life Insurance Awareness Year because of COVID, because people are thinking about, right, their own death and their own financial plan, and are they, have they put the proper steps in place and plans in place? Again, I think that those that are having life events really need to think about the loss of income, the loss, of earning potential if something were to happen. And the other important thing for millennials is they're creating that foundation, which is so crucial to their financial plan, to their future, to their family's future. And so it's important for them to really have that life insurance conversation. And again, we can see at the bottom there the primary opportunities of this group. certainly income protection, and retirement planning. You can never start too soon to plan for retirement, especially if you find millennials that are high income earners. They really need to be having that conversation about asset diversification, about tax diversification, about supplemental retirement income. So if we look at the four groups, right, that we talked about, traditionalists, baby boomers, Gen Xers, and millennials, you can see here, not just the opportunities that make sense for these respective groups, but maybe some other questions to ask them, right? If you're talking to someone in that traditionalist group, it's how are you going to leverage your long-term care expenses, right? Are you going to self-fund if an event happens to you, or is there another solution you can turn to? Maybe a baby boomer is, how did the Secure Act impact you? Do you own an IRA? And if so, who's the beneficiary on that? Is it a non-spousal beneficiary? Let me talk to you about some opportunities around that. Gen Xer, right? Are you saving enough for retirement? Retirement's right around the corner for you. How well diversified are your assets? We're talking to millennials. It's, how are you covering your debt? Are you protecting your loved ones? Do you have kids? Do you have a spouse? What are you doing if there's a loss of income there? And so again, these are questions to ask each of these respective groups. So I would again challenge you to just think about your existing client database in these four segments and say, you know what, am I approaching my existing clients with the right questions, with the right opportunities to meet them exactly where they're at? And if it's not an existing client, if it's a potential client, say, how do I get this person in the door? What are the right questions to ask them so I can talk to the needs that matter to them most? Now, if we kind of move to the side with the age group, maybe a better way for your book of business or for potential clients is to look at them in terms of what type of client it is. So we just looked at, separating clients by age. What if we separated them by the type of client? Maybe you have clients that fit in one of these four categories, either a wealthy family, a high income earner, a business owner, or family planning. So we'll start by looking at wealthy family. Typically, $2 million and upwards in net worth, family or charitably inclined. What we mean by that is it's a wealthy family who has told you as their advisor that, the wealth that we have, we really want to pass that on to the next generation. How do we transfer this wealth to kids, to grandkids, or maybe it's to a charity? And how do we do it by paying the least amount of taxes possible, right? What's the most efficient way to transfer wealth? Typically, these clients are going to be 55 and older that are having this conversation. And we know the primary opportunities, again, with this group are legacy planning, the smart money concept that I'll share about here in a minute, and certainly estate planning. Maybe the client you have or the potential client you have is a high income earner, right? So think a professional, maybe it's a physician, maybe it's an attorney, maybe it's a business owner. Typically they're 55 and younger, six-figure income. And we know that a huge opportunity with this group is supplemental retirement planning, because a lot of people in this category are already maxing out what they can contribute in a 401k or a similar type plan. And it's not nearly enough. If they project that out into the future and they say, this is what I need to live off of in retirement, they're going to have a huge retirement income gap. And so these high income earners, they need an additional bucket. They need that supplemental retirement income plan. And we know that life insurance is a great asset to plug into there. I've often heard, IUL be described as a Roth IRA on steroids, right? Because you can contribute as much as you want. There's no limitations. There's no age, discrimination type stuff. So the fact that you can use life insurance as a supplemental retirement plan is a great conversation to have with these high income earners. Business owner, those of you that are in the business market, maybe you have business owner clients, maybe you don't have business owner clients, but you know people that are business owners. They are also great clients to have life insurance conversations with. Typically, you're looking for a mature business, one that's been around 3 years or more. You absolutely want positive cash flow. And really, they can be any type of business, whether it's a C Corp, S Corp, sole proprietor. But we know that some of the low-hanging fruit, the easy opportunities are around key person and buy-sell opportunities. Key person, because just about every business owner that I've ever talked to and encountered, they can tell you someone who is very important to the day-to-day operations of that business. Sometimes it's the CFO, sometimes it's the top salesperson. I've worked with restaurants where it's a chef. It depends on the type of business that it is, but there's always someone that is very crucial and important to that business. And if that person were to, God forbid, pass away, that business would incur a huge financial impact. And so that's why it's always important for these businesses to think about low cost key person insurance, right? It doesn't cost a lot to do a 10-year term policy to cover someone. So that way, if that CFO died, if that CEO, if that whoever it is passed away, that business would receive that death benefit to help manage the day-to-day expenses while they try and find a replacement. Buy sell equally as important, right? Especially when you have multiple owners. You have owner A and owner B, and if owner B passes away, where is owner A going to come up with the money to buy out owner B's estate, right? Because when owner B's spouse says, you know what, I am now part owner of this business, and I don't expect to do anything operational wise. I don't expect to work in the business, but I do expect a check. Owner A is going to be like, this is really unfair, but I still got to pay the money that I owe. And so wouldn't it be nice if they took out policies on each other to protect against that loss? And that way, again, they could receive that death benefit to buy the surviving spouse out. Buy-sell planning is very important. Again, I would encourage you, if you are in the business market, if you know business owners, ask them, do you have a buy-sell plan? Do you have a key person plan? What are you doing to protect against these things? Because we see it every single day with businesses that fail to do the planning. And by the way, statistically, we know that most businesses are failing to do this type of planning, and it's a huge financial impact on them when they do that. Executive bonus, that a lot of you are probably familiar with that. Maybe you know it under the umbrella of a 162 bonus, but that is a great way to incentivize key employees to recruit, reward, retain those individuals that are important to a business, and using life insurance to do that. Last and certainly not least, just your typical family, right? Maybe you're thinking about clients that don't fit in any of those prior categories I mentioned. Maybe it's a client that's just a regular family that's doing financial planning with you. What are the opportunities there? Policy review. I would say policy review is not just big with this group, it's big with any group. Anytime you can approach a client and say, you know what, I know you have life insurance. I would love to take a complimentary look at that and just make sure that it's the best plan that you can have. And the worst thing that can happen out of a policy review is that you go back to that client and say, you know what, you've got a great life insurance policy. Kudos to you, for picking the right one. But if not, maybe you find an opportunity to save them money. Maybe you find them an opportunity to get more death benefit for the same amount of premium. Maybe you find them an opportunity to add living benefits to a policy that didn't have living benefits on it. So policy review is a great way, I would say, especially in a year like this where people are thinking about their expenses and they're uncertain about the economy. If you can do them a favor to review a policy, and again, maybe find them some cost savings, you will be a hero to them for doing that. But again, families are also thinking about income replacement, especially where you have households where both parents are working. That's really important. And certainly if there's kids in the house, college planning is probably part of the conversation as well. So similar to, what we looked at before with the age group, now we separate clients or potential clients into one of these categories. And again, just depending on where they're at and what type of client it is, you can see here the right type of questions to ask these clients so that you can find those opportunities. Moving on, I just want to share, just for the sake of time, just a few solutions that we're seeing a lot of success with right now. The first is with those clients that are, they want to leave a legacy, right? They're saying, my kids are important, my grandkids are important. We have money that we're not going to use for our own retirement, and we'd like to pass that on to the next generation. Maybe it's to a charity. What's the best way we can do that? What's the way we can leverage the most our dollars, to benefit that next generation? And we have non-correlated asset listed here because a lot of times clients are saying, you know what, I want something that's outside of the market. What's an asset that's not tied, that's non-correlated to the market, that can still give us a lot of bang for our buck? When you think of clients that are planning around this, again, it's going to be that baby boomer generation. Maybe it's someone that fits in that wealthy family group, or just a regular, family planning type client. The example we're looking at here, we got a 6-year-old female, and she's meeting with her advisor and says, you know what, I've got $1 million in assets in an AUM type account, and my goal, again, and I don't need this money. My goal is to leave that to the heirs. What's the best way that I can do that? And certainly, she can leave her money to continue to be invested, and it'll continue to grow. There's nothing wrong with that. But the solution we're looking at here is her advisor says, you know what? Let me show you 2 scenarios. The one on the bottom here, the darker line, is if you leave your $1 million, and we're going to assume a 5% rate of return, over the next 30 years, you can see that that's going to continue to grow. But an alternative approach is, what if we take 3% of that money and we use that to buy life insurance? And we're just going to do that for 10 years. So we're going to do a 10-pay on a guaranteed life insurance policy. Again, we're just taking 3% of the $1 million, 3% of those assets to do that. And you can see that lighter colored line on top, how much more her overall portfolio increases in value. Because, by the way, that 10-pay, that'll buy $722,000 and change of a guaranteed death benefit for this 6-year-old female. And so that increases her portfolio. Instead of being $1 million, automatically, it's over $1.7 million on day one. The remainder of her 97% of the assets continue to be invested and grow as well. And you can see here that the portfolio combined with life insurance outperforms the portfolio that is purely invested in the market. Now, over time, of course, we know that the portfolio in the market will outperform the portfolio in life insurance, assuming that it continues to get those returns going forward. And you can see here that happens at, I think, around age 86 is where that portfolio purely invested in the market would outperform the one with life insurance. But I would argue that the value you brought this client, that if she were to die, especially in the early years, would pass on significantly more to her loved ones. By the way, that life insurance death benefit is tax-free. Also, she has living benefits that should she become ill, she could tap into. And if the market were to go down, guess what will never go down? That guaranteed death benefit, right? So there's some volatility protection built in there. By the way, her life expectancy, approximately age 82. And you can see that at that point, the portfolio with life insurance is still outperforms the portfolio without life insurance. And by the way, that internal rate of return at her life expectancy, 8.35% would be the pre-tax equivalent. That means that this client would have to find an investment out there in the market that would guarantee her an 8.35% at her life expectancy to match what the life insurance is doing. That's very hard to do, to say, can you find me an investment that is going to guarantee me that high of a return in 20 plus years down the road? That's difficult to find. And by the way, that's at today's tax rates. If we actually assume the tax rates are going to go up in the future, which a lot of people do assume the tax rates will go up, that pre-tax equivalent would have to be a lot higher. Here's another solution I want to share with you. And this, you heard me talk earlier about this smart money concept. And so with this concept, typically we're talking about those clients who have a goal that is, liquidity and safety, especially a lot of older clients, those in the baby boomer, maybe traditionalist age group, maybe it's a wealthy family, that they're invested in things like CDs, money markets accounts, savings accounts, maybe it's an annuity. And these are, again, the reason they're investing in these accounts is certainly not because of growth potential, because they're probably not achieving a whole lot, especially in a CD or a money market these days. But they're saying, you know what, we need safety of principal. This is, money we're probably never going to use or need, but in an emergency, we need that liquidity. So we don't want it tied up in the market where it could maybe lose a lot of money. and we don't want it illiquid, for a long period of time. And so that's the reason, and half jokingly here, you can see the picture, this client's, saving their money underneath the mattress. So we look at the example here, who's a 65-year-old female who's got $250,000 in what we call lazy assets. When I say lazy, we're talking about, again, assets that aren't really working a whole lot for the client. They're in a CD, they're in a money market, they're in a savings account. They're kind of sitting on the sideline. And so this 65-year-old female is saying, you know what, I would love the opportunity to get a lot more bang for my buck. I'd love some upside potential, but I need some liquidity. I'm worried about, again, a lot of times when you're trying to get upside potential, the risk is too great, right? You forego the liquidity and the safety of your principal. This example here, she's putting $250,000 into North American Smart Builder IUL. This is one of the most unique products in the market today. You can see $250,000 going in on this illustration all the way on the left. In year one, if we look at that blue column on the left, or circled in blue there, $244,000 and change in guaranteed cash value. In the middle, which is kind of that orange-yellow column, you can see $249,000, and all the way on the right, $252,000 and change in year one. All the way on the left in blue, that is the worst case scenario, doomsday scenario, because not only is it assuming the lowest amount of crediting you can get, it's also assuming North American charging you the highest amount of charges that we can do. So again, it's the doomsday scenario. By the way, if you're curious, North American has never raised our COIs on an in-force block of business in our 100-plus year history as a company. So again, if you were to actually get that blue column, that would be us charging you the most amount we can while the client is also getting the least amount of crediting. Even in that scenario, the client has 97% cash surrender value in that first year. What's more likely is probably something like that middle column or the one on the right. The middle column is showing a very conservative 3.5% rate of return, and on the right is a modest 5%. That's not even the max that we can illustrate, by the way. But because this is a very conservative play, we've dialed that down. And I like to chart it out and look at it this way. The client puts in $250,000, 97% is available in the first year. By year three, full cost recovery. And for the remainder of her life expectancy, even in the absolute worst case scenario, she still has a safety of principal. Hard to find in any other vehicle. Again, what's more likely are the orange and gray line here. That's more realistic on how that cash value will perform. And oh, by the way, I haven't even talked about the death benefit, which is that yellow line. Talk about leverage. Again, she had $250,000 that she's probably earmarked for her beneficiaries, for her heirs. Now, if she were to die, she'd pass on a lot more. But what matters to her as well is that liquidity. She has that in this policy. And oh, by the way, I know the example I just showed, it's 97% cash surrender value. We have a rider on this policy that if the client actually wants 100% cash surrender value, we can provide that in the first year. So again, I choose to illustrate 97% cash surrender value because long-term the policy will perform better that way. But if you have clients that absolutely want 100% liquidity, there's a rider we can attach that'll give that. This is a great solution for those clients that are tired of having their funds sit on the sideline and do nothing in a CD, in a money market, in a savings account, because you can provide them the liquidity they need, the safety they need, while offering them upside potential and leveraging into a death benefit. That is a huge win. Here you can see this additional report that I run on InsMark. That just shows you what a client would have to get in a CD or a savings account to match this Smart Builder IUL. Over 4%. And if you know what rates are these days, you know that it's nowhere near 4%. The reason this product is so attractive is because it has a 0% premium load. It's the only product in the industry that I know of that has a 0% premium load. That's why it works so efficiently. 3 ways that I like to think about this solution is leverage, legacy, liquidity. Leverage the dollars the client has into something larger, providing a legacy for the ones that matter most, and again, still not foregoing that liquidity that is so important for clients. And I'll wrap up here talking about protection. And again, especially I think this is important now that we're in Life Insurance Awareness Month. I know a lot of times, term insurance can seem kind of like Life Insurance 101, but it's still super important when we talk about those clients that are having life events, right? Which we said are probably more that millennial group, but maybe some Gen Xers as well. Those that are still paying down debt, have obligations for business scenarios. Term insurance is so important, whether we're talking key person or buy-sell. Those entering the workforce, we know that the group life, which is probably the most common type of life insurance, is not nearly enough. Most group life policies will pay 2 to 3 times of a person's annual income. And those of us in the industry know that the coverage amount that people actually need is significantly higher. So make sure they have low-cost term insurance. This is a really neat graphic that I saw just a few weeks ago because of Life Insurance Awareness Month. But I really think it highlights, what people ought to be thinking about. Here you can see you've got husband and wife working. They're kind of providing or sustaining that monthly income that's paying for all things like groceries, mortgage, utilities, credit cards, school, tuition. And what happens when one person passes away and you've got dual income household? The financial impact that has on a family, that speaks to the importance of having life insurance to help prop that up so that if mom dies, if dad dies, that it doesn't cause a huge financial impact to that family. They can still meet their obligations. They can still carry out the plans that are important to them. And again, that speaks to the value, the importance of term insurance because it does so much, whether we're talking about business cases or personal cases, term insurance is important. Lastly, maybe you're like so many agents that I've talked to this year that have told me, Andrew, I met with the client in the first quarter. They were ready to buy that permanent life insurance policy. Maybe it was a GUL, maybe it was an IUL. I met with business owner clients who understood the need for planning. They were ready to move forward, and they just couldn't do it because COVID hit. And they said, you know what, I'm going to think about it. Let's hit the pause button. Let's wait. We'll circle back in the fall. Maybe things will be better then. How many times did that happen to you this year where you got a client who understood the value and the importance of life insurance and they just didn't want to move forward, right? And you probably felt like Michael Jordan does in this picture here. So close. Man, I can't believe that the client, they understood it. They saw the illustration. They're ready to move forward. COVID hit and it put this delay. I would challenge you to go back to those clients if you haven't already and think about term. No one's ever going to be as young and as healthy as they are today. If they understood the value of that permanent plan, let's lock in a term insurance plan so we could do the underwriting today, so we can lock in the insurability today, and then tomorrow, whenever they're ready to move forward. The great thing about North American's term insurance is we've got one of the strongest conversion privileges in the industry. You can convert the policy in 30 days. You can convert it in 3 months. You can convert it next year, all the way out through the duration of the term policy or through age 74. And so you can convert that, again, to our GUL, to protection-based IUL, to an accumulation IUL, any one of our permanent products you can convert to. But I would challenge you, don't let those clients who understood the value of that permanent plan, don't let them walk away. Look for a way to do the term today and come back tomorrow and do the permanent. Again, I talked about our conversion, benefits of that. For the sake of time, I'll kind of breeze through this. Living benefits, by the way, our entire product line has these living benefits, critical, chronic, and terminal illness, right, are automatically included. We're one of the few carriers that have it on term. We are the cheapest price carrier that has it on term, and we have it on all of our permanent products as well. Lastly, I just want to highlight some tools and resources, especially in this environment. Being digital is so important, and we provide you the opportunity to do an e-app, online part 2, accelerated underwriting, which we just increased, e-signature and e-delivery for those clients who never want to leave their home, for those advisors that never want to leave the office, who want to do business efficiently. We're here to provide you the platform to do that. Again, our accelerated underwriting, we just increased it a few weeks ago to $2 million for those ages 18 to 50. We also increased the percentage of those being approved. So the majority of our business about 60% is being approved through accelerated underwriting. If you're social media savvy and you use that, please feel free to use all our content that's available for free on Facebook, Twitter, and our YouTube page. We also have a blog that you can access, and again, you can share content on your page. So if that's how you're marketing to clients today, especially if you're in a state where you're maybe not moving around as freely or things are still shut down, feel free to blast our material, especially again during Life Insurance Awareness Month. Now is a great time to do that. We also have a website that you don't need to log on to get to, where we have all of our marketing guides, client brochures, sales ideas that I couldn't cover today. That is all available online. Again, so in closing, I just want to remind you, what we covered today. Think about your clients in terms of segments. What are the appropriate questions we should be asking them? Think about some solutions that make sense for them, and find out if there's tools and resources you can use to help leverage your business. For the client, hopefully they'll find additional solutions that will help them meet their financial objectives. And for you, the agent, for the producer, I challenge you to revisit those existing clients and try to find where the opportunities exist. Again, comb through your database of existing clients. Look at clients that you want to bring on that are potential new clients, and say, what are the questions I ask? What are the opportunities that really matter to them, so I can meet them where they're at? What solution makes sense for them, and how can I work with Financial Markets to do that? Financial Markets is available, to help you with illustrations, to help you with all the material that I referenced earlier. And certainly you can always reach out to me at North American. We're here to help support you, to help you with your business to find those opportunities. Again, thank you for your time this morning. Really appreciate you taking time to be with us on this webinar. And I will turn it back over to Neil and Ed.
Well, thank you, Andrew. Thank you. I opened up saying that it's important information for that fourth quarter, and it certainly is, folks. We had some questions that came in, but you covered them, Andrew, indeed, by your session there. But, folks, that living benefit on term, as Andrew pointed out, very unique there, and the conversion options that you have to convert to. Some carriers, folks, will then limit what you can convert to. And then finally, looking at this fourth quarter, that accelerated underwriting and some of the expansion that North American has done there. So again, thank you, Andrew. And being that premier carrier, folks, we are looking for your life needs, and North American is at the top of the list for us there. At this point, then, I will now turn that over to associate here, Neil Sperling. As promised, we will be holding now this drawing for the participants that have listened to the presentation there today, this valuable presentation. Thank you again, Andrew, and thank you to all those that have been listening today.
Thank you, Ed Bartling, and thank you, Andrew Herrera. Hey, one of the topics that Andrew had mentioned was college planning. We just posted on our YouTube a talk on designing life insurance for college planning. So if you want to hit youtube.com/FMI agent, again, youtube.com/FMI agent. You can sure take a look at that talk. Really, really well laid out. Sometimes it's a little difficult, maybe designing the plan or maybe identifying the correct prospects, and that webinar really goes over that quite well. So, hey, everybody that has been on the call here today has had their name added to the hat, and we'll draw one lucky winner for a $50 Amazon gift card. And you do have to be present on the call at the time of this drawing to win. So in your mind, think of a awesome drum roll, and we'll draw the winner. And the winner is Kelly Eden. Let's see if Kelly is still on the call here. Hello, Kelly. Thanks for joining us, and she's still on the call. So congratulations, Kelly. And also, Kelly, of course, thank you so much for doing business with Financial Markets. And I know your office also values the products and solutions with North American. So thank you for your business there. So we'll turn it back over to Ed Bartling.
Again, folks, we can't thank you enough for the trust that you've given Financial Markets, and we look forward with North American, one of our premier carriers, to help you for those life needs. We are looking for your life. Everyone take care and have a good day.
Thank you, everyone.